and welcome to slide pack 11 of the financial modeling program. What I plan to talk about today is a couple of things on a layout and also on how we can project the income statement. So with that, I will move to an Excel spreadsheet. Now this is a fictitious company acquisition by another company. And what I wanted to show you first here is just the layout of the various tabs. So as you can see at the bottom, the leftmost tab is the summary tab. Next I have an assumptions tab. Then I go into the income statement, the balance sheet, and the cash flow. And after that I've got a valuation tab. And then I've got a tab that looks at what the combined entity's financials will be. Now this is clearly a little beyond the scope of this project, but still I just wanted to sort of give you a brief overview here. Now if you look at how I've laid it out, as I've shown you in the past, I've got a title that talks about TPCC and a potential acquisition. And then I have a subtitle that says financial summary, and then I've got a black line which sort of separates this almost as a header. And then I say key points highlighted in yellow throughout the workbook. Now I say this because the target audience for this type of a presentation are the CEOs of a company, senior management, and the board of directors of the company that's leading the acquisition, and the target company, who, you know, typically this information is sometimes shared with them. So I clearly lay out what all is happening in this sheet. So for example, I tell them that assumptions are the assumptions for all of the projections in this worksheet, and this is in row 6. In fact, I think what I might do is just increase the size here so it's slightly easier to read. I'm hoping this is better. Or perhaps let me just take it up a notch and make it even more easy. And then I tell them what every tab is about. I tell them that TPCC IS is the projected income statement through 2014, and it includes data for 2010 that was provided by the company. And likewise, TPCC BS is the projected TPCC balance sheet through 2014. So without going into too many of the details, what you see here is that I lay out what is happening on my tabs all the way through the merged valuation. And there I have a note that says that it shows the merged entity's projected income statement and earnings per share at various sensitivity levels from 2011 through 2014. Next, I have as item number 2 a summary of the projected financials. So there's projected revenue, pre-tax net income, income tax rate, the amount of cash that there is, and total assets. And I also have an estimated enterprise value of the acquiring company. Then below that, I've got similar stuff along with an estimated enterprise value of the target company. And then on point number 4, this was going to be an all-stock acquisition, so we talk about the percentage of additional shares that the acquiring company is going to have to issue. And then at number 5, we have the post-acquisition target projections. And then we've got key metrics such as this is the percentage gain in the value after the acquisition. And then we've got merged projections. So from an executive standpoint, you know, they can A, see what the flow of the spreadsheet is, B, without going into the details, they can look at a summary of what this financial model's results are through points 1, 2, 3, 4, 5, and 6. Now in the event that someone wants to go into the model, what they have to do is skip to the tab that talks about the assumptions, and here they can see all of the assumptions that have been made in building out this model. It also says clearly assumption estimates in blue font may be changed, and this is in row 4 of the Excel spreadsheet. So here I just want you to pay some attention on the first part, where we talk about the projected income statement and the annual projections that go from a base year of 2010 for which data exists, historical data exists, onto projections for 2011 through 2014. And the numbers in blue font are numbers that management can play around with. Now, this is a built-up model for a company that's in the mining business. So what we do is we talk about building up the income statement based on an increase in the fundamentals that drive the business. So this is the tons sold, the price per ton, the gross margin assumptions, the increase or decrease in the net margin, the estimate that we've used for income taxes, the number of shares outstanding. So we clearly lay out our projections here. If you go down further to point number 2, you'll see that we've done some of the same for the balance sheet, but for this slide pack, we will not be going into the balance sheet. We'll save that for the next slide pack. So I just want to give you a brief overview here of the various kinds of assumptions that we clearly lay out in the sheet, and in fact welcome management to come in and make changes if they'd like to. And now let's go to the income statement sheet, which is our topic for today, or for this slide pack to be more precise. So what you can see, what we have here is actual data from Jan through May 2010. And very simply, we've actually kept this simple so that you get the gist of what the logic is. So there's the amount of tons sold, which can be, you can do whatever you need to for the business that you're in. And then there's the price per ton. It's very simple. The price times quantity gives you your total sales or your total revenue. And then we have a line item for the cost of goods sold, and you take that out, you get your gross income and your gross margin. As you can see, the 76-80% level, which is actually quite excellent. And then we've lumped up the operating expenses. And then we have net income before taxes, we have the net margin, and then the last line that says row 21 net income per ton is really more of a metric that's specific to this business. And the reason why we're sharing this with you is that it's nice to have that kind of detail related to the businesses and the companies that you're working with, because something like the net income per ton is a metric that the CEO can look at and very quickly relate to or comment on. And then below that, what we've got are notes on these financials on, for example, direct costs include blah blah blah, or things like that. And then here we have a breakdown of all of the indirect costs, wages. So this is a very comprehensive model that we have here. So there's data for Jan through May, and then there were certain projections that were made for June to December that were again based on assumptions on tonnage, etc. So let me actually do this to make this slightly easier to see. I am going to collapse these or hide these sheets so you can see this slightly more clearly now. So now what we have here is we've got numbers for 2010, and then we have projections for 2011 through 2014. Now let's move into the projections. So the first metric that we are basing our revenue projections on is the quantity or the tonnage of coal sold by this company that we're talking about. Now if you look at it there, it says it is, and I'll use my F2 key, it is AF9, which is the tonnage sold in 2010, multiplied by a factor that is highlighted in assumptions row F10. So now if I go to assumptions and I go to my row F10, here you'll see that row 10 is about the yearly increase or decrease in the tons sold. So we multiply the increase year on year and we get the total tonnage that's sold. Now, once we have that, the second thing that we want to multiply the tonnage by is the price per ton. So if you look at the price per ton, again, the assumptions for 2011 are the price that we sold it for in 2010 multiplied by some factor in row F11 of the assumptions tab that reflects an increase or a decrease in the price per ton, and we've got that increase or decrease happening on a year-on-year basis. So this is a classic business-based build out of the income statement. So once we've got the price increase and the quantity sold increase, we multiply the two and we get our total sales numbers. Now you subtract. So now what's interesting here is, so we have our total sales. Now how do you figure out the cost of goods sold? So what you'll see here is that what we've done is we've sort of back calculated the cost of goods sold by subtracting the gross income from the total sales. Typically what we do is we have total sales and we take out the cost of goods sold and we get the gross income. But here, oddly or differently, what we are doing is we are taking our total sales and we are taking out the gross income to back calculate the cost of goods sold. So why does that make sense? Well, that makes sense because the assumption that we are making here in projecting our income statement is that the gross margins for the company are going to remain at a level that we pick and choose based on historical performance. So if you look at row 14, gross margin, the gross margin in 2010 based on actual data is 80.8%. Now if you look at 2011, it says it's the gross margin for 2010 plus something that we have on the assumptions tab as F12. So if we go to F12, it talks about the yearly increase or decrease in gross margin. Now the assumption that's being made here, perhaps incorrectly, and in fact we've done this on purpose to highlight that this is perhaps an incorrect assumption, that the gross margin is going to go up 1% every year. That in reality may not be true, but we're trying to make a point here and we've made that assumption. So what we've said is that if it was 80.8% as gross margin in 2010, it's going to go up to 81.8% in 2011 and 82.8% in 2012 and 83.8% in 2013 and so on and so forth. Now, I did this because I want you to understand that you cannot willy-nilly make assumptions. And gross margin is something that is very difficult to increase. So if you're already at an 80% gross margin level, to say that I'm going to ramp it up 1% a year, I mean, theoretically you'll soon be at 90-95% in about a decade, which is really not the way, even though you wish that's how your business would run, that's not how it really pans out in reality. So be careful about how you increase your gross margin assumptions. Also note that what we are doing here is we are holding an assumption for gross margin using that percentage. If you look at the formula for the gross income, all we are doing is we are taking the sales, total sales, and we are multiplying it by the 81.8% to come up with our gross income number. Once we have a gross income number, all we are doing is plugging back the difference and saying this is what our cost of goods sold will be. Now this is a fair approach when you build out your income statement. So it's completely okay to say, you know what, I am gonna pick a number for gross margin and I'm gonna sort of base that number to calculate my gross profit and back calculate my cost of goods sold. So that's how we get to the gross income. Now if you look at the operating expenses number, again, you'll see this seems like an odd number. It says gross income minus the net income. So again, it's a back calculation. And the thing to note here is that what we have done, again, and you'll see that this is linked to the net margin in 2010, which is AF20, plus assumptions F13. And if you go to assumptions F13, this is the yearly increase or decrease in the net margin. Now, what you will see here is that the company's net margins, based on comparable information on other competitors, showed that the net margin actually needed to be improved. And so the management made a commitment that it was going to increase the net margin by 5% in the year 2011, and that once it took it up by 5%, it may incrementally take it up by another 1% or 0.5%, but by 2014 it expects to have reached its optimal net margin percentage, which is why they do not anticipate further increases beyond a certain point once they've reached what they believe is a sustainable net margin. So I wanted to sort of point out the differences in how we handled gross margin, where we kept it increasing, and how we handled net margin more realistically, where we increased it, albeit perhaps some would say a little too much, but it really depends on the company that you're dealing with. But ultimately we got it down to a point where we say, okay, no more increases in net margin. Now, going back to our income statement projections, what you'll see here is that we have the assumptions in blue for the net margin, and then using that assumption, we multiply the total sales by the net margin to get the net income before taxes, and then we just back plug the operating expenses. So this is a completely okay approach on projecting your income statement. And then once we've got the net income before taxes, we basically divide that by the number of tons sold to get the net income per ton. And so what we'll do is we'll stop here. And as you can see down here, there is a lot more detail, which is what I highly encourage everyone to do, because this is building a financial model while taking into cognizance the real operating details within the company. So this, in a nutshell, was some guidelines on building out your income statement. We skipped over the operating expenses. We lumped it up. You might want to do that. Or you might want to go into more detail depending on time and importance, and what the scope of the exercise is and what the purpose is. You might want to calibrate the level of detail that you want to go to, and accordingly make assumptions on whether you want to hold the number of staff employees constant, whether you want to hold their salaries constant, whether you want to hold equipment depreciation up or down based on the asset purchases you make. So you'll have to make a whole bunch of assumptions on your income statement. So with that, we will stop here. Thank you very much.